Good morning. The meeting will please come to order. Welcome to the annual meeting of shareholders of Security Federal Corporation. I am Christopher Reeves, Chief Executive Officer of the company. At this time, I will turn the meeting over to Roy Lindbergh, President of the company.
Thank you, Chris. Good morning. A list of the shareholders of the company entitled to vote at this meeting has been prepared and arranged in alphabetical order, showing the holders of the common stock of the company as of the close of business on March 11, 2024, the record date for voting. The records of the company show that on the record date, there were outstanding and entitled to notice of and to vote at this annual meeting 3,229,325 shares of common stock, of which 1,614,600 represents a majority. An affidavit has been provided that the notice of meeting and a form of proxy, therefore, were mailed on or about April 8, 2024, to each holder of record on the close of business on March 11, 2024. A copy of the affidavit with the documents attached will be attached to the minutes of this meeting. The Board of Directors is required to appoint an inspector of election and has previously appointed Beverly Nettles, Assistant Secretary of the company, to act as inspector of election at this meeting and any adjournments. The certificate and report of the inspector will be attached to the minutes. The inspector has the list of shareholders and all proxies which have been received. More than a majority of the 3,229,325 shares of common stock entitled to vote at the meeting are present by proxy. The inspector has made an exact count and will submit a formal report on the number of shares present or represented during the course of the meeting. A quorum has been declared present, and confirmation of that fact has been made by the inspector in her report. The first item of business to be acted upon by the meeting, as stated in the notice of meeting, is the election of 3 directors of the company. In accordance with the bylaws of the company, 3 individuals have been nominated: Timothy W. Simmons, Harry O. Weeks, Jr., and Roy G. Lindbergh. There have been no other nominations, and no nominations may be made at the meeting. Therefore, I declare the nominations to be closed. Shareholders are entitled to 1 vote for each share of stock owned, as shown in the records of the company. Directors will be elected by a plurality of the votes cast. Cumulative voting is not permitted. I declare the polls closed for the election of directors. The second item of business to be acted upon by the meeting, as stated in the notice of meeting, is the advisory vote on the approval of the compensation of the company's named executive officers as disclosed in the executive compensation tables and related materials included in the proxy statement for this meeting. I would like to request that a motion be made to submit the advisory proposal on the compensation of the company's named executive officers to a vote.
So moved.
Thank you. The vote will now be taken on the motion. There were no shareholders who gave notice that they intended to vote at the meeting. Therefore, I declare the polls closed on the motion. At this time, Christopher Reeves will give us an overview of this year's performance.
Good morning again. Security Federal earned $10.2 million in 2023. Our earnings remained level year over year, primarily due to the rapid increase in interest rates impacting our cost of funds as a result of the Federal Reserve's efforts to contain inflation by slowing the economy. The higher rates imposed by the Fed created problems for banks. As we know, banks fund long-term loans with deposits that are primarily shorter term, and that lets the bank's raw material costs, in other words, our deposits, suddenly increase while longer-term loans and investments stayed at a lower fixed rate. The end result was a rapidly increasing cost of funds with little corresponding increase in revenue. The compression in profit margin continues to erode profitability, resulting in the risk of lower net income year over year. All of this will unwind or normalize as loans and investments mature and reprice at today's higher rates. In fact, it is slowly happening now, but will take some time. Until this works its way through normalization, earnings for banks, including Securities Federal, will be challenged as compared to last year. The last 2 years, our Chief Financial Officer, Darrell Raines, has worked to communicate the complicated impact on bank earnings resulting from the actions taken by the federal government. These widely contradictory actions, from massive fiscal and monetary stimulus to include forgivable PPP loans in 2021 and near zero interest rates, to near unprecedented monetary tightening through rapid interest rate increases, all occurred in a short period of time. Banks have been whipsawed as the Fed had its foot on the accelerator while slamming the brakes. It has created an uneven effect on recent bank earnings. The actions were at odds with each other, which makes it difficult to discern the underlying performance of Securities Federal and many other banks over the last several years. However, if you look at our key bank metrics over the last 4 years, compounded annually, you will be able to get a clearer picture of our underlying performance. Since 2019, our earnings have increased 7% per year. Our assets have grown 13% per year. Loans have increased 8% per year. Checking and savings accounts have increased 16% per year. Non-interest income, excluding mortgage performance and gains on sale of investments, continues to increase at 7.5% a year. Importantly, our capital levels are still very strong and our reserves are nearly twice our peers. Our strategy is based on our knowledge that, number one, we cannot predict the future. Number two, we do know that once or twice in a decade, there will be significant unpredictable events that will severely test us. For example, the subprime loan crisis in 2008 and COVID in 2020. Therefore, we invest in preparedness, not prediction. Knowing that, part of that preparedness includes sticking to the basic fundamentals of banking, accumulating healthy levels of capital, and having a strong level of reserves. The extra insurance we take out is well worth the cost. We will continue to base decisions on the long-term best interests of our bank, not the short-term. Notwithstanding the bumpy last few years, we continue to grow in a solid, steady, and safe manner. We continue to believe that our best years are ahead.
Thank you, Chris. This is Roy again. I would like to take a few minutes to discuss our investment portfolio because it is our largest asset category at year-end at $700 million. You may have noticed our common stock's book value per share has fluctuated the last few years. When interest rates rose dramatically in 2022 and 23, the value of our investment portfolio decreased and had a net loss from book value like all other banks in the country. The mark-to-market of our unrealized gain or loss net of taxes of our available-for-sale investment portfolio has a direct effect on the company's equity. As a reminder, we don't mark our loans to market, and on the other side of the balance sheet, we don't mark our deposits or borrowings to market either. The mark-to-market in deposits would have had a favorable effect on net assets or equity. At year-end 2021, our book value per share stood at over $35 per share, with a positive mark-to-market and investments of almost $13 billion to the good. When interest rates rose in 2022, at year-end 22, book value per share fell to under $24 per share, with a net unrealized loss on investments of about $41 million. During 2023, interest rates stabilized mid-year, and we had benefited by reinvesting or deploying about $6 million per month in cash flow from our investment portfolio. Some of that cash was used to fund loan growth, and some was reinvested in the bond portfolio. So at 12/31/23, book value per common share bounced upward, almost reaching $29 per share, where we are more accustomed to having it be. As a reminder, during COVID, we were blessed with cash and deposits from the government stimulus, and consumers were not spending money. With rates near zero, we had to invest that cash. Unlike Silicon Valley Bank, we did not go real long in the maturities. We did take a few nibbles, but mostly went short or in adjustable rate securities. At year-end 2023, half of our investments were in adjustable rate securities. Data from different sources show our duration of our investments are about 3 years compared to peer banks, which are longer at about 4.5 years. Also, our yield in our portfolio is about 1% or 100 basis points higher than our peers, and our mark-to-market loss is only 7% of bonds compared to 10% for the peer group. This indicates that our book value should bounce back quicker than average. That concludes my remarks. Our next speaker is Phil Wall, President of Security Federal Bank. Phil?
Thank you, Roy. Security Federal Bank had another solid year despite the significant challenges faced by the banking industry in 2023. Our focused business development and risk management efforts have resulted in continued profitability and stability. Strategic collaborations between our financial services officers, branch managers, and business solutions team yielded significant new business, municipal and nonprofit depository and treasury services relationships that provide important sources of low-cost deposits. Our team of trust professionals delivered record earnings growth from the trust management and estate settlement services. At the same time, our commercial, consumer, and mortgage lenders grew our loan relationship outstandings by over 13%. We diversified our loan mix with a focus on commercial, residential, and consumer lending, and we maintained our high credit standards and underwriting practices, resulting in low levels of non-performing assets. Although our origination volumes of home mortgages in the secondary market were negatively impacted by increased interest rates, our mortgage loan officers work closely with our financial counseling team to meet the affordable housing needs in our communities. As a certified community development financial institution, CDFI, we are committed to serving the low and moderate income individuals and families in our market. We provided $14.8 million in low-cost, 100% mortgage loans for portable housing needs in our designated CDFI markets. We also partnered local governments, nonprofit organizations, and agencies to offer financial education, counseling, and assistance to individuals in our communities. And we continue to visibly support our communities through various outreach initiatives, along with donations to local charity and nonprofits and volunteering many hours of in-person hands-on service. We also expanded our physical presence and reach in the growing Augusta, Georgia market by opening a new office in downtown at 1109 Broad Street. The new office offers a full range of banking services, including consumer and commercial lending, trust services, drive-through banking, a 24-hour ATM, and state-of-the-art digital banking platform. The new office also showcases our community-minded focus and investment with an award-winning restoration of a historic 1924 building combined with modern design elements and a customer-friendly layout inside and outside. In fact, just last month, we were honored to receive the Georgia Trust for Historic Preservation's highest award and recognition for excellence in historic preservation, the Marguerite Williams Award. The Georgia Trust recognition for the single preservation project in the state of Georgia that made the most significant impact in the state in 2023. We are very optimistic about the many opportunities and future prospects for our bank. We are especially proud of our more than 260 employees who diligently serve our customers every day. We will continue to pursue our mission of helping people, changing lives, providing banking services with a personal touch. We will also seek to leverage our CDFI status, our community involvement, and our new offices to increase our market share, diversify our revenue stream, while being mindful of the importance of providing service at the high level that our customers deserve. We appreciate you, our shareholders, and your continued loyalty and confidence in Security Federal Bank. I will now ask our CFO, Darrell Raines, to provide a more detailed overview of Security Federal's financial results in 2023. Darrell?
Thank you, Phil. Yes, 2023 was indeed a challenging year, not only for us, but many banks. Still, we were able to achieve favorable results for our shareholders. As a reminder to those on the call, the charts and tables in the annual report may be a useful reference as I share a few thoughts about the company's earnings and financial condition for 2023. But first, as Chris indicated, the actions of the Federal Reserve continue to have an impact on our fees, but we have taken action to reduce risks. In the span of just about a year and a half, the Fed lifted interest rates 11 times from nearly zero to bringing the key federal funds rate to approximately 5.5%, which it has held steady since July of last year. To put that into perspective, that's the highest rate since early 2001. That's 23 years ago. And not since the 1980s has the Fed hiked rates at this speed. The increase in interest rates and the speed in which they were raised has impacted banks in two major ways. First, as Chris mentioned, cost of funds have been increasing faster than earning assets, which is causing net interest margins to decline. And worse, as Roy made reference to, some high-profile banks that have funded their operations with high levels of uninsured deposits found that the decline in value of their investment portfolios left them vulnerable to liquidity risk. Of course, I'm speaking to the failures of Silicon Valley Bank and Signature Bank in 2023, and more recently, Republic First Bank. These events highlight the importance of risk management, the importance of maintaining appropriate levels of liquidity, and the importance of having effective contingency funding plans that can be activated in hours, not days or weeks. It also highlighted the danger of funding operations with high levels of uninsured deposits. Fortunately, Security Federal does not. For comparison, Silicon Valley Bank is reported to have had nearly 85% of its deposit base uninsured, and that compares to 27% for us. So during 2023, we took action to substantially increase our on-balance sheet liquidity. In addition, we restructured our collateral base to maximize both the capacity and the operational readiness of our wholesale borrowing facilities. We periodically test those facilities to ensure they can be accessed when and if needed, again within hours, not days or weeks. With that as a backdrop, let me share some of the positive changes in our balance sheet over this challenging past year. Most importantly, we continue to grow. Total assets are now $1,549 million. That's an increase of 12%. Our portfolio loans, which we continue to emphasize due to our relatively low loan-to-deposit ratio, total $622 million. That's an increase of 13%. We saw increases, as Phil mentioned, in construction, residential mortgage, and commercial real estate loans. Our on-balance sheet liquidity, which is cash and cash equivalents, totaled $128 million. That's an increase of 350%. On the liability side, total deposits were $1.195 million. That's nearly an 8% growth rate. The growth in deposits, however, reflected a shift in deposit mix. Checking and savings deposits, which is our lowest cost deposit, decreased 9%. They total $562 million compared to $619 million last year. On the other hand, money market accounts and certificates of deposit increased 29% and now total $633 million compared to $490 million last year. Like most banks, this shift in product mix is causing the cost of funds to increase faster than earning assets reprice, which is compressing the margin. Looking at common stockholders' equity, common stockholders' equity totaled $89.4 million. That's an increase of 15.7%. The change was primarily retention of earnings, less 52 cents per share in dividends paid to shareholders. But it also included an improvement in accumulated other comprehensive loss during the year. And that's just a fancy way to say that the value of our bond portfolio actually increased year over year. As a result, as Roy mentioned, book value per common share increased 16.5%, or $3.92 per share during 2023. If you're someone like me that looks at numbers a lot, you would have noticed that book value per share increased at a slightly higher percentage than the growth in common equity. And that's due to the share repurchase program the company adopted in June of 2023. Market conditions, coupled with our strong capital position, provided us the opportunity to repurchase additional treasury shares at favorable levels. Through the end of the year, we were able to purchase an additional 26,000 treasury shares below book value. And as you probably know, this has a positive impact on book value per share and earnings per share going forward. And now a few comments about the income statement. As Chris mentioned, net income for 2023 and 2022 was $10.2 million, or $3.14 per common share. That equates to a return on common equity of 12.7%. And that's the highest rate of return we've achieved over the last 5 years. Other notes are an increase in net interest income of $1.7 million was offset by a similar increase in operating expenses year over year. In addition, our effective tax rate was reduced due to some historic rehabilitation tax credits we received this year related to our new branch in Augusta, Phil just mentioned. One comment about net interest income, however, year over year, the increase was due mostly to increased volume of interest earning assets. Because like most banks and what we've talked about, the margin has decreased. And for us, that margin decreased 14 basis points from 3.03 to 2.89%. That may not sound like very much, but 1 basis point in the margin represents almost $135,000 in annual pre-tax earnings. So put another way, if our margin had stayed the same, the net interest income would have been about $2 million higher. Looking at other sources of income for the company, non-interest income was actually down slightly this year, roughly 2%, but still totaled $9.4 million. As Phil mentioned, the principal reason for the decline was related to our mortgage division. Fixed rate single-family loan rates remained high last year, and that continued to dampen demand, which caused a significant decrease in secondary market mortgage production. As a result, gain on sale of loans declined $1.1 million, or 63%. If you notice on the non-interest income chart in the annual report, however, in 2020 and 2021, the mortgage division performed very well and contributed significantly to the results during those years. Other sources of non-interest income that are not rate sensitive continue to improve and nearly offset the mortgage decline. As an example, deposit and check card fees total $4.2 million, which is an increase of 9%, reflecting higher transaction volumes and continued growth in the number of checking accounts and treasury service clients. Our trust division also continued to grow and positively contributed to net income. Trust fees totaled $1.9 million. That's a 20% growth rate due to growth in assets under management and several state settlements during the year. And now a few final comments on asset quality, the allowance, and regulatory capital. We did not record a provision for credit losses in 2022. We recorded a small net provision of $246,000 in 2023. However, we did adopt the new accounting standard for loan loss reserve, CECL, which resulted in a $784,000 increase in the allowance for credit losses. And if you look into the footnotes, you'll notice that we actually had net recoveries this year of $6,000, so very little charge-offs. At December 31, the allowance for credit losses was 1.98% of total loans, which is very consistent with prior year and well above our peers. Asset quality remained good. Non-performing assets represented less than 0.5% for both 2022 and 2023. And finally, a comment on regulatory capital. Regulatory capital levels were again strong at year-end, and the bank exceeded the amount considered to be well capitalized under the applicable regulatory requirements. To put this in perspective, on the chart, you'll notice at the end of the year, the bank's Tier 1 leverage ratio was 9.8%. The level considered to be well capitalized under the FDIC rules is 5%. So under that measure, the regulatory capital is nearly 2 times that deemed by the regulators to be well capitalized. Similarly, Tier 1 risk-based and total risk-based capital is roughly twice the amount deemed to be well capitalized. So in summary, yes, these are turbulent times for banks, but on balance, 2023 was a good year for Security Federal Corporation. We've taken steps to both protect and enhance shareholder value. To summarize, we ended another year with strong levels of capital, good earnings, a conservative level of loan loss reserves, excellent credit metrics, a highly liquid balance sheet, and standby liquidity facilities that can be activated if needed. During the first quarter of this year, the board increased the quarterly dividend to shareholders nearly 8% from 13.14 cents per quarter. That concludes my remarks, and I thank you for the opportunity to speak with you this morning. Roy, I'll turn it back over to you.
Thank you, Darrell. The inspector has completed her count of the votes. The report of the inspector confirms that quorum was in attendance at the meeting for all purposes. It also shows that Timothy W. Simmons, Harry O. Weeks Jr., and Roy G. Lindbergh have been duly elected as directors of the company to each serve for a term of 3 years. The report also shows that more than a majority of the shares cast by proxy at this meeting have been voted in favor of the approval of the advisory vote on the compensation of the company's named executive officers. The report of the inspector will be attached to the minutes of the meeting. At this time, we will open the meeting for questions.
Well, I have a comment, not really a question.
Okay.
Can you hear me okay?
Yeah, David, go ahead.
I just want to, given the banking environment that exists right now, I just want to congratulate and thank management for its excellent and very responsible stewardship of our bank. And secondly, additional thanks for all of the support that you give to our community, the participation with events as well as organizations. And special thanks to Gary Wirtz, who recently became treasurer for the Friends of the Aiken Symphony. We appreciate his stepping in and giving us a hand there. And one other comment is I wish the board would consider face-to-face stockholder meetings for the next year. Nothing can replace a face-to-face meeting, and COVID is long gone.
David, thank you. This is Chris. Thanks so much for your comments and your suggestion. We typically plan for our annual meeting at, I'd say, January, February of each year. The last few years, we found that we had, I think, limited attendance, and we decided to do it remotely, and actually have had a lot of good feedback on that too. But we'll certainly take a look at that and our options again next year, and we do value your input, and we appreciate that. And we also appreciate your strong interest in Security Federal and the support of us, and it just means a lot to us.
Thank you, Chris.
Yeah, thank you, David. Any other questions from any at all? Okay, I don't believe there are any questions. Thank you. There being no further business to come before the meeting is adjourned. Thank you for attending, and we look forward to welcoming you back next year.